Hey everyone, welcome back to Corporate Dakota, the place where we crack open these corporate filings to see what is really going on under the hood, especially when it comes to those juicy financial tables, because you know that is where the real story often hides, so be ready. We're diving into a recent shareholder report that has got some interesting numbers, and yes, some more complicated financial J. Argon will break it all down so you can understand the health and direction of these companies. And hey, if you dig getting straightforward insights from these documents, make sure you are subscribed and join our Discord community, linked down in the description for even more discussions. Alright, let's get into this report about the Advisors Inner Circle Fund III, which includes a few different funds. We're going to focus on two main ones. The First Foundation Fixed Income Fund and the First Foundation Total Return Fund. Think of the report as a peek into how these funds performed over their last fiscal year ending the 30th of September 25. First up, for the fixed income fund class of shares, if you had hypothetically invested $10,000 last year, it would have cost you about $123. That may not sound like much, but it is over 1% of your investment going towards fees and expenses. For the Class Y shares of that same fund, the costs were a bit lower, around $98 for that hypothetical $10,000 investment, so a little over 0.9%. This difference in cost usually comes down to which share class you are invested in and the fee structure associated with it. Now, for the performance numbers for the fixed income fund, class of shares returned around 3.92% without load. That means without paying any upfront sales charges. The benchmark index, the Bloomberg US Aggregate Bond Index, returned 2.88%, and their peer group, the Intermediate Core Plus Bond category, returned 3.40%. So the fund actually beat both its benchmark and its peer group. The report attributes this outperformance to their skill in choosing the right bonds. The fund managers had some concerns this year about the economy and the Federal Reserve's independence. They are worried that political pressure on the Fed to lower rates could lead to inflation and misallocation of capital. They've been cautious with their investments in riskier bonds and are actively managing the bonds they hold to keep them within a certain duration range. They are looking to capitalize on mispriced securities and are prepared to shift their strategy if the market outlook changes. Let's look at the long-term performance for the fixed income fund. For a hypothetical $10,000 investment made back in September 2015, by September 2025, classes shares without load would have grown to about $12,956. The benchmark index would have grown to about $11,998. So over that 10-year period, the fund has delivered a better return than the index. Breaking down those long-term results for the fixed income fund class A without load, the 1-year return was 3.92%, the 5-year return was 1.44%, and the 10-year return was 2.62%. For comparison, the benchmark had a 1-year return of 2.88%, a 5-year return of negative 0.45%, and a 10-year return of 1.84%. So the fund has generally performed better than the benchmark, especially over the longer periods. For Class Y shares, the returns were slightly higher, showing that sometimes those lower fee classes can give you a bit of an edge. Looking at the fund size and what it holds as of the 30th of September 2025, the total net assets were around $72.6 million. It had 130 holdings, and the advisory fees paid were about $233,053. The portfolio turnover rate was 22%. This turnover rate tells us how often the fund buys and sells its holdings. A 22% turnover isn't super high, so they are not actively trading in and out of positions constantly. Now let's see what the fixed income fund invested in. Mortgage-backed securities make up the largest chunk at 40.3%. Then you have financials at 11.1% and US government agency obligations at 8.7%. They also have a decent portion in US Treasury obligations at 5%. This shows they have a strong focus on the traditional fixed income market. Looking at specific investments, the top 10 holdings include various GNMA or Government National Mortgage Association securities, US Treasury notes, an FHLMC or Federal Home Loan Mortgage Corporation security, and even an Intel holding. This mix of government agency-backed securities and corporate bonds is pretty standard for a fixed income fund. A notable change here is that Deloitte and Touch LLP resigned as auditors and PricewaterhouseCoopers LLP was appointed as the new auditors. This kind of change can happen for various reasons and is worth noting. Now let's shift our focus to the First Foundation Total Return Fund. For Class A shares, the cost for a hypothetical $10,000 investment were about $134 last year, which is a little higher than the fixed income fund at 1.32%. For the last year, the total return fund class of shares without load returned 3.62%. This also outperformed the Bloomberg US Aggregate Bond Index, which returned 2.88%. The managers of the total return fund are looking for a combination of US and international stocks, along with bonds. They are using an active approach to asset allocation and holding concentrated positions. They've been finding more attractive investment opportunities globally than in the domestic market. They mentioned that the S&P 500 index is trading at 24 times forward earnings, a level higher than its peak multiples historically. Because of this, they have reduced the portfolio's risk and are not mirroring the major stock and bond indices. They've kept their equity weighting around the mid 60% range, but believe their forward correlation has shrunk. Looking at the long-term performance for the Total Return Fund, a hypothetical $10,000 invested in September 2015 in Class's shares without load would have grown to about $24,492 by September 2025. Compare that to the S&P 500 index, which would have grown to $41,530. So while the fund has grown significantly, it has lagged behind the S&P 500 index over this 10-year period. This is a classic example of active management trying to balance risk and return compared to a broad market index. Breaking down the returns for the Total Return Fund, for Class A without load, the 1-year return was 3.62%, the 5-year return was 13.89%, and the 10-year return was 9.37%. The S&P 500 index, however, had a 1-year return of 17.60%, a 5-year return of 16.47%, and a 10-year return of 15.30%. This clearly shows the S&P 500 has provided significantly higher returns over the past decade, a key point for investors to consider when choosing between an actively managed fund and an index fund. Class Y shares of the Total Return Fund showed slightly higher returns than Class A, again demonstrating the impact of lower fees. For the Total Return Fund, the total net assets were about $84.5 million with 69 holdings. Advisory fees paid were around $456,827, and the portfolio turnover rate was also 22%. The Total Return Fund has a very different focus than the Fixed Income Fund. Communication services is their largest sector at 25.6%. Then you have US Treasury obligations at 18.7% and financials at 13.5%. The smaller allocations towards areas like mortgage-backed securities at 0.5% and asset-backed securities at 0.0% indicate a much more equity-focused strategy, with still a significant allocation to government bonds as a stabilizing factor. Their top 10 holdings are quite international, with companies like CIE de Laudet Bolor Lagardère Canal, Saprorisky Royalty International Workplace Group Burford Capital, and Suncor Energy. They also hold us treasury notes. This global diversification and concentration in specific large international companies is a key part of their strategy to maximize total return. When we look at the overall picture here, it appears the Fixed Income Fund has been doing a solid job of outperforming its benchmark, which is great for bond investors. They're navigating a complex economic environment with a cautious but skilled approach. On the other hand, the Total Return Fund, while performing well in its own right, has faced a tougher challenge keeping pace with the strong market returns of the S&P 500 over the last decade. This highlights the trade-offs between active management diversification and the potentially higher rewards of simply tracking a major index. The decision to change auditors from Deloitte and Touch LLP to PricewaterhouseCoopers LLP is an important note in the administrative side of the funds. These are big accounting firms, and such a transition is usually handled with care and thorough review by the Board of Trustees. Looking at the shareholder report as a whole, we see clearly laid out performance metrics, costs, and investment strategies. The funds are emphasizing their focus on asset allocation and credit analysis, especially in the fixed income space. For the Total Return Fund, the strategy involves a global approach and active management, which has led to different performance outcomes compared to a broad equity index. The report also discusses the renewal of advisory contracts, where the board reviewed many factors including fees, performance, and conflicts of interest. This annual renewal process is standard, but it shows due diligence by the trustees. The shareholder reports also include extensive notes to financial statements detailing accounting policies, valuation methods, and various risks. These risks are crucial for investors to understand. For example, the report mentions market risk, credit risk, currency risk, and specific risks related to mortgage-backed securities and emerging markets. These are all factors that can impact the value of their investments. The presence of a significant portion of mortgage-backed securities for the Fixed Income Fund means that interest rate changes and prepayment speeds will be major drivers of performance. For the Total Return Fund, the concentration in specific international companies and communication services sector points to a strategy focused on specific high-conviction bets. In my opinion, the Fixed Income Fund seems to be delivering on its promise of outperforming its benchmark and peer group consistently over the long term thanks to what appears to be disciplined credit selection. The Total Return Fund, on the other hand, presents a more nuanced picture. Its active management approach has resulted in higher costs and potentially lower long term returns compared to simply investing in the S&P 500 index. This is not necessarily a bad thing, as active management often aims to mitigate risk a factor. They seem to have prioritized with reduced equity weighting and a focus away from traditionally expensive domestic markets. However, investors need to be aware of this underperformance relative to the market index and weigh it against their risk tolerance and investment goals. The auditor change is a standard part of corporate governance, and unless further details emerge, doesn't immediately signal a problem, but always worth keeping an eye on. Alright, that is our breakdown based on this filing. What are your thoughts on these funds and their performance? Do you think the active management strategy for the total return fund will pay off long term? Let us know in the comments below if you found this deep dive valuable. Please hit that like button and subscribe for more breakdowns like this. And be sure to check out the Discord link in the description for discussions and to connect with other viewers. Thanks for watching, and we'll see you next time.